Okay, I might get us kicked off with some of the formalities while people are still joining us. So thank you very much for those of us who've made it from a very punctual start. My name is Sarah Brewin. I'm a company strategist with ACCR, the Australasian Centre for Corporate Responsibility. And I'm really pleased to welcome you to this webinar today ahead of the Shell AGM, which will be held next month, and this opportunity to speak to a shareholder resolution that we have filed as ACCR together with Brunel Pension Partnership and other institutional investor co-filers. So we'll be pleased to speak to that resolution as well as to the research underpinning that resolution, and we're really pleased to be speaking to you in collaboration with Ceres today. So just a couple of brief and sort of obvious formalities. The webinar is being recorded and the recording will be shared to those of you who've registered. So if you can't stay for the whole time, or if you have colleagues who have missed out, you will get the link to a recording shortly after the webinar concludes. We'll be drawing from the research that I mentioned into Shell's LNG Outlook, as well as our recent response to the Shell Notice of Meeting, which came out last week. Our response was published to that today, and we have links to both of those resources, which we can share with you in the chat. So with that out of the way, let me quickly get into introducing our speakers and our agenda for this webinar. So we're really pleased to be hearing first from Andrew, who I think will be known to many of you. He's a Senior Director of Climate and Energy and Oil and Gas at Ceres, and he'll be providing us with some framing remarks to contextualize the discussion within the current US landscape for institutional investors in oil and gas. Then we'll be hearing from Vaishnavi Ravishankar, who's the head of Stewardship at Brunel Pension Partnership, which is one of the co-filing institutional investors behind this shareholder resolution. And she'll be speaking to Brunel's rationale for filing the resolution and some of their history of engaging closely with Shell over the last few years. And then my colleague Nick Mazan and I will be presenting the research underlying the resolution, which looks into Shell's LNG portfolio, its demand assumptions, and its climate commitments. So with that, let me hand over to you, Andrew, for some framing remarks.
Great. So thank you, Sarah, and thanks to ACCR for inviting Ceres here today. I'm really looking forward to learning more about what, from my perspective, is perhaps the most important climate proposal going forward in the global oil and gas sector this year. And I think that's both because I think the proposal is really quite strategic in how it's framed, really focusing on the company's long-term bet on LNG in a decarbonizing world. But also, unfortunately, because there are so few shareholder proposals going to a vote at all this year in the oil and gas sector, there's a number of reasons for this, but I think, a key one has been a quite aggressive effort by many companies to really restrain the rights of shareholders to raise concerns with the companies that they own. It's no surprise, for example, that ExxonMobil, a year after suing its own investors over a climate proposal this year for the first time in at least 30 years, will not face a single shareholder proposal on any issue. And I know that Shell has at least threatened to challenge the legality of this proposal. I think we'll hear probably more about that later on the call. But all just to say that I think that this vote will be closely watched and really deserves a lot of attention from investors. And beyond that, while Shell is obviously a British company, I think there are quite a few reasons that North American investors should pay close attention here as well. I mean, beyond the obvious that a majority of Shell's investor base is actually US based, and the company does continue to make noise about potentially relisting its shares in the US. I think it's important to keep in mind that Shell has been a real bellwether in the industry on climate. It was the first oil major, for example, to set a Scope 3 target, and its then CEO actually did a lot of work behind the scenes to bring some of his peers along to also set targets around their product emissions. So Total or BP or Repsol. So just as Shell back then taking leadership steps was important. I think Shell potentially backtracking on its climate commitments also has tremendous importance, beyond the company itself. And I do think it's clear, and I think we'll hear more about this in a bit, that the very large bet that Shell is making on LNG is pretty directly tied to the company also backtracking on decarbonization. The company's demand assumptions around LNG only make sense in a world that is not taking climate change seriously and is not decarbonizing at any sort of a significant pace. And I think you can see this in other aspects of the company's strategy. Its pullback in low carbon investment, the rollback of some of its targets. I was at the company's Capital Markets Day last month in New York, and at sort of at a side table, the company's head of investor relations told me, clearly not knowing who I was or who I was representing, that he didn't place any real value on the company's Scope 3 targets, and that Shell would gladly abandon them, but wanted to wait for his peers to move first. I think he said we can't be the ones leading the charge on this, but they're hopeful that their peers will lead the way, and then they can kind of follow in that wake. I think it was also pretty clear to me from the capital markets presentation and discussions that the company really has no idea how it's going to meet its long-term reduction targets if it does end up maintaining them. It's growing LNG production. It's not really shrinking its oil production. It's investing less and less in low carbon. And, when pressed, the CEO really couldn't articulate what its value add even was in the low carbon space, other than sort of, waving its arms around at the idea of trading and the black box of trading, and that being a place that could add value, but again, not being able to really speak to what that meant in practice. So I guess two other takeaways for me from the Capital Markets Day that I think are relevant here. First, there was quite a bit of frustration from the analysts in attendance, who by and large don't really care or think about climate change. But there was great frustration about the company's valuation. And I think quite a bit of skepticism that the path the company is on is going to change that valuation. So I think this proposal comes in a context of real doubt, or skepticism, I guess, about that strategy, which I think is helpful. And then, related to that, there was quite a bit of questioning and skepticism around the company's projections for LNG demand going forward. Really just the concern being that the company is basically making projections that justify what it's already planning to do, and ignoring some recent trends, particularly out of China, that suggests that future demand could be much more constrained than Shell seems to think or hope. And also some interesting questions from analysts around the idea that sort of paradoxically that the glut in supply that might be coming in LNG in the next 5 or 7 years could actually raise costs for the companies involved, because it could pull enough gas out of U.S. production, for example, for export, that it materially raises the cost of that gas. So potential that the company's heading for really a kind of a double whammy, where there might be both too much supply with rising costs, chasing less demand than hoped. And of course, no one's crystal ball is particularly clear these days, particularly, but again, lots of reasons to at least question what is really an outlier approach that the company is taking. So that's kind of a little bit of perspective from the US on this, and I will pass on to the next speaker, or back, Sarah, to you.
Yeah, thank you so much, Andrew. That was really, really useful framing for the conversation that we'll be having. So let me now turn to Vaishnavi Ravishankar, who I said is the head of stewardship at Brunel. And we just wanted to get some perspectives from you, Vaishnavi, to why Shell is an important company for you, for Brunel, and how this importance has sort of shaped the tenor of the longer term engagement that you've had with them.
Thanks, Sarah. We've been engaging with Shell on a number of different topics, and specifically on its climate commitments for over 5 years, I think. In the last couple of years, we've selected to escalate through co-filing shareholder resolutions, mainly because we found the company's response to engagement quite underwhelming. As a lean team, we must sort of balance the benefits and the costs of any escalation strategies very carefully. But this is a company that continues to be one of the top contributors to our financed emissions. And the dialogues we've had so far have continued to bring to question the credibility of their net zero targets.
Thanks for that, Vaish. And could you maybe speak to some of the key concerns that you've had around Shell's LNG strategy and why you saw, in light of those concerns, that the sort of right next step was to be filing a shareholder resolution?
I think our key concern has been how the company will actually meet its net zero target while expanding its LNG business significantly. As most of you would be aware, they retired their 2035 target and adjusted their 2030 NCI target last year, and no new targets have been proposed. So there is a question as to whether the company is really being straightforward about their position around climate issues. The filing for us is on the back of very timely research from ACCR and intensive engagement with the company since November last year, which I think failed to provide us clarity or assurance around some of the questions that we had for them. Given their LNG strategy, it continues to be a sort of substantial component of their growth strategy, and it's built on a very optimistic demand outlook. We're asking for more information around the basis for the assumptions embedded in the LNG demand outlook, which seems to be well about IEA scenarios, including the steps in a scenario which yields a 2.4 degree warming, and how this demand is then reconciled with their broader strategy and climate commitments, particularly during the sort of 2030 to 2050 period.
And then maybe just lastly, what could you speak a bit to sort of what you would be hoping as Brunel to be achieving through the resolution and then the ongoing engagements that you're having with the company off the back of the resolution?
Yeah, the focus for this resolution is very much on transparency. So we can't be accused of being over prescriptive. I think there's plenty of room for the company to determine how it's going to respond to the asks, which we think are very reasonable questions around what is underpinning their strategy. We think the onus is really on the company to strengthen their LNG strategy and disclose additional information that will then enable us as investors to appraise the risks associated with the LNG portfolio and then determine the compatibility with their climate commitments. We remain open to engagement, and we have a meeting with the chair coming up in May. But so far, the company's response to our asks have not gotten us to sort of rethink this resolution. They do hold the view that all the information we are after is already publicly available, but we are looking for the company to substantiate how the LNG business will remain competitive as renewables scale up, and the likely downward pressures on pricing we'll be seeing. They also claim to be Paris aligned, but is that claim really credible? I think we need to resolve our understanding of how the life cycle emissions of the LNG business matches up with that sort of trajectory. And if the company believes that their climate ambitions are untenable, then we need to see further sort of modeling and narrative from the company around why that is and what steps it is taking in order to respond to that scenario.
Yeah, thank you very much for that. I think that's a really great segue into the presentation. And I think Nick will just take a moment to pull those slides up. And where we'll sort of kick off with the presentation is really by looking at the resolution text itself. And I'll just give that a moment to get up on your screens. But what you can see here is the text of the resolution. It was filed, as we said, by Brunel, Greater Manchester Pension Fund and Merseyside, together with ACCR and Share Action at the end of last year. I won't read the text of the resolution out to you. You can see it on your screens, but I would just flag a couple of things about this and strengthen a few of the points that have already been made. And primarily the fact that this is, as Vaish said, disclosure-based resolution. So we're really looking for enhanced transparency from the company here. and not aiming to be overly prescriptive, as Vaish has said. The second point is that this was filed as a special resolution. This is in accordance with the requirements of the UK Companies Act and Shell's own Articles of Association. So a special resolution is the appropriate vehicle for shareholders to use to compel enhanced disclosures from companies. And Andrew alluded to the fact that the company has been making assertions around the validity of this vehicle, and we saw that come out in the notice of meeting last week, but we are very much confident in the sort of legal ground on which we brought the resolution as a special resolution under UK law. So the first question that we get whenever we speak to this resolution, and when we first filed it at the company and had engagements off the back of the resolution, was what do we actually expect to see as a response to these resolution asks? And if we can get the next slide up, our approach when answering this question is really that it's not for the co-filing institutional investors to be providing the company with a prescriptive checklist of disclosures that would meet the ask of the resolution, but rather that we think the company should be given the latitude to respond to the resolution as it sees fit. And ultimately, our role here is to highlight the types of legitimate questions that we think are material concerns for investors and questions that are currently unanswered and unanswerable in light of the disclosures that the company has already put out. And the way we think about these questions really falls into three broad categories or three buckets that also sort of cleaves to the way we've thought about our research and the evidence that we have that underpins the resolution. And that speaks to the degree of financial risk inherent in the growth strategy or the LNG growth strategy that the company is putting forward, and in particular, how it intends to protect long-term shareholder value in light of a suspected coming supply glut and increasing competition from renewables in the price-sensitive emerging markets that the company is targeting. We have concerns along really significant concerns relating to the demand assumptions that the company is building this strategy on, and in particular why that demand outlook has been so unresponsive to some of the major changes in global energy markets that we've seen come online over the last few years, and that we've seen other commentators significantly downgrading their LNG outlooks in response to. And then lastly, this category of climate commitments, and as Vaish spoke really eloquently to just a few moments ago, so I won't reiterate the point too strongly, how the company intends both to grow its LNG business and to achieve its climate commitments. And that's really the crux underlying this resolution ask. Before we get into the research and start unpacking some of the financial risks that we've identified with Shell's LNG strategy, just to quickly set out what that strategy is. So the company aims to become the world's leading integrated gas and LNG business. And to do that, it's set itself targets in terms of growing its liquefaction capacity and growing its LNG sales. And we've started to see significant FIDs coming online in pursuit of those targets. And Nick will speak a bit in a moment to the Argentina LNG acquisition, which is a really significant one for the company. And we also see this strategy being baked into the remuneration policy for directors. So that's the left side of the screen, the sort of LNG growth ambitions. The right side of the screen sets out the company's climate commitments. Its commitment to net zero by 2050, which it sees as being aligned with the 1.5 degree Paris goal, its NCI target, and then its sort of broader narrative around how it sees the role of LNG as contributing to the energy transition. And so really at the heart of the resolution, we're trying to square the two sides of this ledger and understand how the company can both grow its LNG business while achieving its climate commitments. Let me pass over to Nick, who's going to speak now to the financial risks inherent in the strategy.
Thanks very much, Sarah. Yeah, so on this first slide, we're looking at a cost comparison between a base case scenario, and we're using Rystad here. And the reason that we're using Rystad is that Shell don't disclose what the commodity price assumptions they use are to value their assets. And so taking Rystad, we think, is a sort of fairly central assumption there, which is $12.9 long-term average per MMBTU. And then we're comparing that to a $5 price environment. And the reason that we're doing that is there's a lot of rhetoric from the company around coal to gas switching and the role of LNG in terms of both baseload power. And so we asked ourselves this question: what price would LNG have to be to really be competitive with renewables in many of these sort of Asia, Southeast Asian markets? And so the way we did that is we looked at the levelized cost of electricity of LNG versus building fixed access solar. And that's looking at sort of the cost of running a combined cycle gas turbine with the cost of building new fixed access solar. We did this in India, we did this in China, we did this in a few other countries in Southeast Asia, where Shell talks specifically around the role of LNG within the power sector. This was in their 2024 LNG Outlook. And then we adjusted the commodity price that was used in those levelized cost of electricity assumptions, and we adjusted it downwards until we got to a price where it was at the top end of building renewables within those countries. And we got a range of $4 to $5 per MMBTU. The International Energy Agency, the IEA, have done something similar, and they got a range of $3 to $5 per MMBTU. The problem with this price environment, and this is not us saying that sort of this will be what prices are, this is the price that LNG would have to be competitive with renewables. But the problem for Shell and other oil and gas companies is that at $5 per MMBTU, they're losing money for every cargo they sell. So the life cycle costs of LNG around $8 to $9 is structurally a very expensive energy source. When you think about the cost of regasification, the cost of liquefaction, the cost of transportation, it's just structurally very expensive, and it's hard to see how those costs will go down. And Andrew's spoken a little bit about that as well. And the industry as a whole has a very bad track record of delivering projects on time and on budget as well. When we've looked at Shell's historical capex into LNG projects since 1990, we found that they've only returned marginal amounts of positive NPV despite deploying a huge amount of capex over that sort of 30-year time period. Anyway, to look between these two scenarios, we find that there's a potential impact to the value of Shell's LNG assets around $90 billion between these two price environments. And so this is sort of significantly material to the company. When we think about this in terms of the broader value of the organization, this is about well over half of the integrated gas business, which is the largest part of Shell's business. When you take this to the company, you'll hear from them sort of that they do this analysis, or they do look at the downside risk associated with a lower commodity price environment. And the way that the document that they'll point to is note 4 in the annual report and accounts. And this is something that was mentioned in the notice of meeting as well, that they're looking to expand this. And sort of maybe that's a recognition that it doesn't go far enough. But we've conducted some analysis and compared that to sort of the way in which we're looking at the company's LNG portfolio. And the difference is that the company is doing an impairment test. And so that's the difference between the book value and the residual value of those assets. So what doesn't this take into account? That doesn't take into account the value that those assets are expected to create. So looking at the commodity prices and what is the value that's going to be created from those assets, and what will the impact of a lower commodity price environment be on the returns associated with those assets. So we don't think that the way in which this is presented in terms of doing this impairment test is necessarily the most useful for investors on the buy side and the sell side in terms of how they think about the value of the assets and the market capitalization of Shell. And so we get vastly different numbers from Shell's estimation of $21 to $27 billion because of this, and we get to a figure around $90 billion. You can see in the appendix of this sort of the full breakdown of how these methodologies work, but this is sort of the high-level takeaways from that. The other question that we get sort of as it relates to sort of why we're focusing on Shell here is sort of what makes Shell different from other oil and gas companies. How do they compare to other integrated oil and gas companies? And you can see here the size of Shell's uncontracted LNG position compared to peers. So you can see Shell's is around 1.4 billion tons of LNG through to 2050. It's around twice that of Exxon and Total, who are the next biggest in terms of their uncontracted position. This has increased quite substantially. We ran a similar analysis in October, November of last year, and we had around 1 billion tons of uncontracted LNG through to 2050. It's increased mainly because of quite a lot of M&A activity. Argentina LNG in particular, which is a pre-FID project, is around 100 million tons of LNG that they've acquired in Q4 of last year. And then we've calculated what the financial impact of lower prices might be on the company's NPV. And we model that for every dollar that LNG prices fall, there's a potential $14 billion impact on the company's net present value. So seriously material for the company's overall value. And as we think about sort of the impact on prices, again, sort of we're not here to do price forecasting, but we can look at some historical proxies around when prices have been lower and when markets have been oversupplied, or when the supply demand dynamics are different. And when you look back to sort of the 2019 period, you can see when markets were oversupplied, LNG prices were considerably lower and sort of much more than $1 per MMBTU. And so we would expect significant price movements as we see all of this oncoming supply that's expected through to 2030. Organizations like Bloomberg New Energy Finance, the International Energy Agency, are predicting this oversupply coming through the system, some in 2026 through to 2027, maybe through to 2028 as well. Total Energies are in the same boat in terms of projecting this oversupply. Interestingly, as it relates to Shell's 2025 LNG Outlook, this is something that they do spend some time on, and their sort of conclusion was that there isn't going to be this oversupply and there's going to be this tightness in the market that's maintained, mainly because oil and gas companies, as I mentioned earlier, are bad at executing LNG projects. And so instead of being delivered on time, they're going to be delivered in a delayed fashion, and that's going to maintain the tightness in the market. And it's kind of ironic and funny in some ways that Shell is leaning on the fact of poor project execution, of which it is a part itself, as a reason for prices to stay higher over the long term. We did flesh this out in our heads a little bit about what this means. Is that a good thing? Is that a bad thing? And probably came to the conclusion that higher prices in the short term is fine, as long as it doesn't incentivize further capex, which Shell are implying that it does in terms of what their demand forecast looks like, because it leaves more space for renewables to come online in that period. And that's just sort of cannibalizing the potential for LNG over the medium and long term, and therefore sort of pushing that out of the system essentially, and reducing the incentives for further investment in LNG infrastructure. On the next slide, we look in more detail at Shell's trading book, and there's quite a lot going on here. This is sort of one of the most technical slides that our research team has put together. The way I like to understand this is I read it from bottom to top, and on the bottom half, so below zero, this is the company's production and their purchasing agreements. And then on the top half of the graph, you have their sales agreements and their uncontracted LNG position. The big takeaway here is sort of how much that uncontracted position increases from 2025 to 2035. It's an increase of 177% over that 10-year period. There are lots of other interesting aspects to this. One of the big changes from our report that we put out in Q4 2024 is that the pre-FID section of this has increased substantially, partly because of Argentina, but a few other projects as well. And this really changes, I suppose, the concerns that we have, both from being one of concern around sort of what is the size of this exposure and how is the company going to manage this risk, but really how big could this exposure get, or how much could this risk get, how much worse could this risk get if the company does approve these FIDs in the next sort of 3, 4, 5 years, which is what is to be expected in terms of increasing that uncontracted position. As it relates to the company's contracts, we used to have a sort of slide which netted these out, but basically when you do that, what you have is more exposure to Henry Hub pricing on the purchasing side of things. They're the largest off-taker of US LNG. And then on the sales agreement side, you have a net exposure to oil index pricing as well. And so the company can get squeezed. I mean, as US prices, as we see sort of increased liquidity in LNG markets, increased liquefaction capacity that Andrew alluded to earlier, from the US, that's going to put pressure on Henry Hub pricing and then compress the margins related to those Henry Hub contracts. And as oil prices are decreasing at the moment, again, mainly driven by politics in the US, that's going to compress the margins on the sales side of things. So having these contracts is not sort of a risk-free solution. It doesn't take away all of the risk, but it does reduce some of the volatility, which is quite problematic within LNG markets. One of the things that we'll hear back from the company and maybe investors as well is that these contracts work on a sort of 10, 15-year rolling basis, and that sort of the expiration of these contracts in 2035 is natural. And as time goes on, Shell will continue to sign more contracts. I think the problem in this thinking is that it assumes that LNG markets are going to sort of continue into the same regime as they have been over the past sort of 3, 4, 5 years, where really sellers have had this massive advantage in terms of sort of the power structure and the dynamics here. And what we expect to see with this massive increase in supply over the next 5 years and the tip of the power balance from sellers to buyers, that it is going to be much more difficult for sellers to be negotiating those contracts. And sort of getting into the same sort of contracts at the same prices that they have in the past. And so using that sort of past performance to project future performance, I think is going to be really difficult. And you can think about this from a case study perspective as well. Regions like Europe and Japan are very unlikely to want to sign on to longer term contracts when there's so much concern around the energy transition. No European sort of power producer has really sort of a strong idea what their gas demand is going to be and doesn't want to be signing a contract beyond 2040 at the moment because of that nervousness around regulation and then around sort of the accelerated deployment of renewables as well. I'll keep going in terms of looking at the company's disclosures from the Capital Markets Day, and Andrew gave some really interesting insights into sort of what was sort of happening behind the scenes. I suppose I was sitting watching this with Sarah, but we sort of hearing Andrew's first-hand insights is really, really interesting. In our negotiations with the company, one of the things that they put forward to us in their sort of original proposal, but was also included in the notice of meeting, was that they disclosed the cost competitiveness of their portfolio relative to peers. This is what seems to have been attempted within the Capital Markets Day and what's presented on the right-hand side here. And when you look at this from face value, it looks fantastic. You see these yellow bars, all of Shell's are to the left end of the cost curve, and it paints a very rosy picture. But we took some time to have a look at this in more detail and see whether there are any issues with this. And what we found is that what Shell is doing is predominantly including backfills, which is the cost of part of a project, and comparing that to the full greenfield CapEx relative to peers. And so when you're comparing the cost of part of a project or the cost of a full project, undoubtedly the cost of a part of a project is going to be cheaper and therefore sit at the lower end of the cost curve. So we don't see this as sort of an apples to apples comparison. The other thing that you traditionally see when you look at cost curves is you see the width of these bars representing the equity position or the size of the offtake agreement that Shell would be getting. And all of these bars are sort of equal size and don't give that sort of fair represented view. And we, on the next slide, when we remodel this, we look at that and sort of bring into sort of the picture these factors. Shell also show the average delivered cost from US Gulf Coast exports. And this overlooks the fact that, as I mentioned, Shell is the biggest offtaker of Henry Hub gas, and actually some of their contracts are above average as it relates to the average delivered cost from the US. So on the next slide, we did this remodeling and we sort of showed this breakdown. And what we've done here is remove those backfills. So removed where it's only been sort of a part of a project, maintenance, CapEx, that sort of thing, and only looked at where Shell is investing in sort of the full scope of the project, and then looked at where they sat on the cost curve here. And then we brought in the equity positions related to these projects as well. And you can see Qatar, super cheap. There's always going to be the most resilient through the energy transition. Trains 8 to 11, some of the cheapest LNG in the world, will be some of the last LNG ever sold, undoubtedly. But Shell's position in Qatar's train 8 to 11 is 6.25%. So they have a tiny position and they're getting a very small amount of LNG from those projects. Comparatively, LNG Canada, which is a $40 billion project in which Shell have 40% of, is the most expensive project under development for them. And you can see that sits sort of really high up the cost curve and above the global average in terms of LNG projects as well. We've also included in here Shell's Henry Hub offtake agreement and sort of the average cost of those contracts delivering into Asian markets on the JKM as well. And you can see, again, that sits very high up the cost curve as well. So we don't think that the way in which Shell has represented this in terms of the cost competitiveness is a fair representation. And when you look at it in this more objective way, you get a sort of better picture of Shell's position and sort of really how competitive their portfolio is. And maybe it's like marginally better than the global average, but it really is pretty close and definitely not what is represented in terms of their capital markets disclosures. I'll hand it back to Sarah.
Thanks very much, Nick. Yeah, so moving now away from the LNG portfolio and looking to the company's demand forecast. And what you're seeing in the chart here on the right-hand side of the screen is Shell's LNG demand forecast charted against the three IEA scenarios. So what you're looking at in the blue band at the very top of the graph is the 2025 outlook in that blue, light blue range, and then the purple dotted line is the 2024 outlook. And the top of that blue range goes up to the 718 million tons per annum, which is 21% higher than the IEA STEPS scenario, 96% above the APS, and 310% above the NZE. And so what can we say about this? I mean, we're obviously at a moment in time where there is a lot of debate and a lot of discussion about whether we're in fact on a 1.5 degree pathway. And there's some legitimate concern even about the feasibility of the APS, but to be taking a position which is 21% higher than STEPS, which is a 2.4 degree warming scenario, and a scenario which is a business as usual scenario, one that assumes no further emissions reduction policies being implemented between now and 2050. This is a position that we find concerning for investors, and we also find, implausible, even in the sort of current political conditions. So the other thing to note here is that to be sitting 21% above the STEPS, not only would you need to see no further policy implementation for this demand scenario to eventuate, but you'd also need to see a sort of widespread and fairly systematic degree of policy rollback, of policies being rolled back on or failing in their policy objectives. And that would need to happen to a degree that the company is simply not able to substantiate at this point. And we have put this to them directly in engagements, and we've asked them to explain the delta between their outlook and the IEA STEPS, and to justify this position. And the line that they've taken with us is that they think that the IEA STEPS has a lot of good news baked into it. They see it as unrealistic, and to substantiate that position, they've shared a handful of examples of what they see as policy rollbacks. And they've cited, for instance, a cancellation of a ban on new gas boilers in the UK or delays to nuclear restarts in Japan. And so they've taken this sort of fairly scattergun approach to providing sort of niche examples that don't have really material impacts on LNG markets. And we just don't think that this is sufficient. We think the company still has a lot more work to do to explain how it arrives at this position and to justify how they see a world in which the net result of policy change over the period reaching out to 2050 is one of less climate ambition and not more. The other thing to say about this is that in addition to sort of justifying this position and sitting this far above the STEP scenario, we would ask ourselves as well how the company sees a scenario that would result in 2.4 degrees of warming having impacts on its own demand forecast in a sort of fairly circular way. So we know that the company is betting big on demand coming out of emerging markets in Asia, and it's really hitching its wagon to economic growth in Asia as driving LNG demand. We also know that 2.4 degrees of warming would have really significant adverse impacts on economic growth worldwide, but especially in a particularly climate-sensitive region like South and Southeast Asia. And we can kind of see how at the macro level that economic growth would be severely disrupted by that degree of warming, but also we can see at a project level and some of these impacts already hitting home for the company and for the industry more widely. There were cyclones in Bangladesh last year that lasted for 4 days and that took some of the country's floating LNG import terminals offline for 4 months. We also heard at the company's results update a few weeks ago that they had to downgrade their LNG production guidance as a result of cyclones off the coast of Australia. So we're not seeing the company explaining the delta between its own LNG outlook and the IEA steps, and we're also not seeing how it's factoring in the physical risks that would be baked into a 2.4 degree world. And so this is kind of underlying this incongruence that we've identified in the resolution ask. So here's a historical analysis that looks at how the company's LNG forecast has changed or not changed significantly over the past few years. And what we do here is show the difference between the company's 2020 assumptions and its 2024-25 assumptions, and we compare that to those for the IEA for these same periods going forwards. And what we can see is that the IEA have decreased their demand assumptions for 2035 and 2040 rather, quite considerably over that time period, whereas for Shell, their long-term LNG demand projections haven't materially changed. And so why are we seeing this downgrading coming from the IEA? Well, it's partly because of the decreasing cost of renewables, and it's also because we know that as a result of the Russian invasion of Ukraine and the price spikes in LNG associated with that, that the fuel has acquired a really tarnished reputation in South Asia and in Southeast Asia, where a lot of the countries that the company is now targeting as part of its growth strategy were priced out of the market. There were major price spikes associated with that, which resulted in widespread energy insecurity, widespread human suffering, civil unrest, and policymakers in those countries have had to respond to that and have been responding to that. And we can take a few good case studies from countries like Vietnam, whose power development plan in 2021, the power development plan in 2021 revised downwards its expected power from LNG by 50% compared to the previous plan, which was out in 2021. Pakistan imported 22 gigawatts of solar modules last year, which is equal to about 44% of their overall grid capacity. So we're seeing major policy moves in these countries away from LNG because of the concerns around energy security and price volatility as a result of this crisis following the Russian invasion of Ukraine. And we're not seeing Shell's LNG Outlook responding to these trends in the same way that other independent commentators are. So just briefly to touch now on the LNG Outlook itself, and I suppose to bring together a few of the strands of the research that we've already spoken to. So we've seen that the company has this ambitious growth strategy for LNG. Nick's explained that it has this outlier status in terms of its uncontracted position, and that leads to significant financial risks and financial exposure inherent in the way it's building out its portfolio. And I've just spoken now to this bullish demand forecast, which is not well substantiated and which is well above what we're seeing coming out of the IEA, and that hasn't sort of updated priors in response to major changes in global energy markets. So sort of bringing these three things together, we really think that places a significant onus on the company to justify its position. And so where we would look for it to do that is its LNG Outlook, which it published in February of this year. And we would look to that outlook to see how is it making these pieces of the puzzle fit together. And the research that we've shared goes into this in quite a bit of detail, but at the sort of top line, what we could say is that the company has not discharged this onus of responsibility to explain its outlier position in its LNG outlook. And it doesn't go far enough in justifying how what it identifies as demand drivers will actually be increasing LNG demand out to 2040 to the degree that it's forecasting this 60% growth. And so just to sort of give you a flavour of that, what you're seeing on the left-hand side of the screen here is from the LNG Outlook, and it's sort of from the opening pages of the Outlook, where they sort of set out their sectors, key sectors where they see natural gas demand coming from out to 2040. That's the chart on the left. And then they list out what they call LNG demand drivers on the right-hand side. And what's notable about the chart on the left is the sort of thinnest of these bars being transport is where the LNG Outlook spends the majority of its time. So it talks a lot about LNG in maritime settings and quite a lot about LNG in trucking. And it spends almost no time substantiating the LNG demand it sees coming out of the power sector, out of the industrial sector and buildings as well. And this is a notable change from last year, where there was quite a bit of coverage in the 2024 outlook around the industrial sector and the use of LNG in Chinese steel decarbonisation. And that's simply absent this year. So there's quite a fair bit of swapping out of demand drivers while not actually bending that demand curve down at all, and in fact going in the opposite direction. What's notable about these demand drivers that it lists out is that they're sort of put in the headlines at the top of the LNG Outlook. They're referred to in the media release that accompanied the Outlook and the talking points from the CEO when he was speaking publicly about the Outlook and speaking at the CMD. These sort of high-level narratives have been thrown around, particularly the use of AI in data centers, the use of LNG in data centers and AI. And this is an example of a demand driver which is put really prominently and then has no substantiation anywhere else in the document. Asian economic growth is another big part of the story that we know coming from Shell, and where it sees a lot of its LNG demand growth coming from. In terms of how they substantiate that in the LNG Outlook, you know, they provide a sort of handful of snapshots of how they consider, or rather of how they evidence this demand coming out of emerging Asia. They provide, for instance, some charts showing Asian regasification capacity. And we just know that this is not a good proxy for demand, because we know that there's huge fluctuation in utilization rates of this infrastructure. So what we're really not seeing here is a sort of joined up, overarching evidence-based narrative as to how these demand drivers are going to translate into the type of long-term growth in LNG demand that the company is betting on. What we see instead is a sort of flimsy, factual snapshot of short-term trends and developments really over the past 12 months. And we're not seeing the degree of reassurance that the financial risks inherent in the company's LNG growth strategy that Nick has spoken to are well justified and being well managed. Nick, let me pass back to you.
Sure, thank you. One of the other problems that we've noticed in terms of Shell's narrative around LNG demand is that when they talk about signing long-term contracts, they're using this as a signal around sort of the confidence in LNG over the medium to long term. And so they point to the existence of these long-term contracts from 2030, 2040 through to 2050 as a proxy for this high confidence in LNG demand over those time periods. But when you break down sort of who is actually signing those contracts, it becomes very interesting. And so what we have in the left-hand side here is the composition of those contracts between portfolio players, which essentially oil and gas companies, and then end users, so sort of utilities or industrial companies as well. And you can see as the tenor of those contracts increases out to the 2040s, you can see the proportion of which is populated by portfolio players such as oil and gas companies increases up to around 50% for the contracts in existence beyond 2040. And then what's also interesting on the right-hand side is when you look at that at a company level, the biggest purchaser of those contracts from 2031 to 2050 is actually Shell themselves. Total, Novatek, CNOOC, and BP also form in sort of the top 10 largest companies signing these contracts beyond 2031. And these oil and gas companies, for the most part, they use them a little bit in the sort of transportation of LNG, which is mainly driven by LNG powered ships and sort of that maritime piece that Sarah spoke about. But for the most part, they aren't using this LNG. So they're signing these contracts through to 2050, but don't intend on using it. And so we don't think that is a strong signal of long-term LNG demand, and one that sort of will demonstrate a strong confidence in LNG. And these companies like Shell are going to have to find a home for that LNG going forward. So we're going to have to find end users to sell it to, and they can't just keep selling it between themselves. That's not a profitable strategy. Finally, on this slide, this sort of goes into that levelized cost of electricity piece that I spoke about at the very beginning when we were doing the sort of financial analysis of what is the cash flows associated with a lower commodity price environment. And this goes into sort of the two big countries that Shell mentioned. There was a bit of a transition between the 2024 outlook and the 2025 outlook, previously focusing on emerging Asia, countries like Bangladesh, Vietnam, Malaysia, in terms of power demand growth there. We've seen this pivot away from those countries and to India and China. And what we've done here is looked at that levelized cost of electricity. And you see India, I mean, India has like some of the cheapest solar in the world. And the cost of building new PV, even building new PV with storage, is half the cost of powering an LNG to combined cycle gas turbine plant in the country. And so we just don't see these economics sort of stacking up in these countries. And the sort of justification for Shell is sort of, how is this going to be a driver of bulk LNG demand? Because I don't think the intermittency question really answers that. If you're sort of using gas peaker plants and they're being used on an intermittent basis, they're being used sort of a very small percentage of the time, that isn't going to drive the sort of large sums of LNG that Shell is forecasting in their LNG outlook. When it relates to sort of the operation of these assets, even if those assets are in existence, if the LNG is too expensive, they're just not going to run. We know that the average utilization rate in India for combined cycle gas turbines is only 8%. And that's really shocking. And that sort of highlights the fact that even if you have these assets, when the cost of the fuel is so expensive, it's just going to be a non-starter. And India is a really interesting case study, not just for power, but for other sectors as well, because it is marked as this big growth area for LNG by the company. And where we have seen growth is trucking in India and fertilizers, both of which are heavily subsidized. The trucking piece is sort of especially interesting because there's been a huge amount of lobbying from third-party organizations, and that's a whole other piece of work that we've been doing, looking at Shell's participation in lobbying activity around LNG in emerging markets. They've been quite successful on the tracking piece, but in India, it's really fertilizers and tracking which are supported by policy, and then in no other markets are we seeing any sort of LNG growth because just the economics don't work out.
Thanks very much, Nick. That brings us to the end of the technical presentation and pretty much to the end of the time that we have allotted for this webinar. So thank you very much for joining us. We hope that it's been useful in informing your votes at the upcoming Shell AGM. And if there are any follow-up queries, we're very much available to assist with that, and we'll be circulating the recording of this webinar as well as the other materials that we mentioned in support of the resolution shortly after this event. So thank you very much. Thank you to Andrew and to Vaish for joining us, and to Ceres for co-hosting this event. Thank you all and enjoy the rest of your day.